So, welcome back to Monthly Indonesia Economy Focus. Pour yourself something. We're diving into September 2025, and honestly, this month was wild. Like, genuinely one for the history books. Here's the thing, September gave us this perfect storm of bold moves colliding with absolute chaos. Bank Indonesia did their fifth rate cut. The government threw 200 trillion rupiah at state banks like they were making it rain. And we locked in these massive trade deals with the EU and Canada. Sounds great, right? Except all of this happened while a cabinet reshuffle was literally tanking the rupiah. Classic Indonesia. The question we're wrestling with today, and I mean really grappling with, is whether you can just stimulus your way out of weak demand. Like, can you? We're going to dig into what economists are saying, what think tanks are screaming about, what's bubbling up on social media. The whole messy, complicated picture. So settle in. We're following September's arc from the macro stuff through all the policy drama, sectoral wins and losses, trade victories, and what this all actually means going forward. Okay, so let me paint the picture of why September matters so much. This month was like watching two completely different movies at once. On one screen, you've got decisive action. By cutting rates despite the market freaking out, the government literally injecting 200 trillion rupiah into state banks, which is bonkers, and these genuinely impressive diplomatic wins with Europe and Canada. Bold stuff. Aggressive. The kind of moves that say we're serious about growth. But then on the other screen, political chaos. The September 8th cabinet reshuffle, which included, just casually, replacing the finance minister, triggered $960 million fleeing the country in 4 days. 4 days, the rupiah dropped 0.7% immediately. Investors were not having it. This tension, this collision between aggressive policy and jittery investors, that's September's whole story. And the question threading through everything we'll talk about today is whether these big policy moves can actually create lasting recovery, or if they're just fighting against problems that are way deeper and more structural. The optimists think this is the growth pivot we needed. The skeptics, they're worried about credibility erosion and fiscal disasters waiting to happen. Let's look at the actual numbers, defining where Indonesia's at right now. Big picture, growth fundamentals look pretty solid. GDP stayed strong between 4.7 and 5.12% year-on-year, with Q2 hitting 5.12%, the fastest we've seen since mid-2023. And this wasn't just statistical magic, there was real economic activity happening. The drivers were clear enough. Private consumption expanded around 5%, households were still spending. But the really striking thing was fixed investment jumping to 6.99% from only 2.12% in Q1. That's a massive leap. Though, and this is important, we don't really know if this is sustainable momentum or just companies front-loading capital spending because they're worried about tariffs coming down the pipeline. Here's where it gets interesting, though. Underneath these headline numbers, there's weakness. Core inflation at 2.17% screams tepid demand. We had monthly deflation of 0.08% in August, worse than last year. And consumer confidence dropped to 117.2 from 118.1. Not exactly the profile of an economy bursting with confidence. This paradox, strong growth meeting weak demand signals, is going to keep coming up. And when you dig deeper, economists point out that Q2's 5.12% masks vulnerabilities like exports slowing down, projections for full year 2025 dipping to around 4.8%. We're losing ground to Vietnam's 5.2 to 6.2% pace, especially in labor-intensive stuff like textiles where our global market share has just stalled. In my view, this exposes a structural flaw. Indonesia's nickel obsession, the whole downstreaming strategy, it's capital-intensive. Which sounds great until you realize it's creating way fewer jobs than we need for the 10.7 million people entering the workforce every year. But anyway. Now this is where it gets messy. What I'm calling the policy paradox, basically the tension between throwing everything at the economy and markets just not buying it. The September 8th cabinet reshuffle created immediate shock, and it really shows how fragile investor confidence is. Let me walk you through the timeline, because it's honestly kind of devastating. Leading up to September 8th, things were actually looking good. From August 8th through September 8th, Indonesia had net portfolio inflows of $460 million. The rupiah was strengthening from 16,825 to 16,300 per dollar. People were optimistic about Fed rate cuts. Capital was flowing into emerging markets. Everything seemed fine. Then September 8th happened. The reshuffle announcement, especially changing the finance minister, triggered an immediate reversal. On September 8th alone, $250 million in net outflows, 0.7% currency depreciation. Over the next few days through September 11th, total net outflows hit $960 million. The market's message was crystal clear. Confidence is fragile, and uncertainty about policy coordination has real, immediate costs. Questions about fiscal monetary alignment, about these burden-sharing arrangements between BI and the government, about where fiscal policy is even heading under new leadership. All of that uncertainty translated straight into capital flight. This volatility sets up everything that happened with monetary and fiscal policy in September. From an analytical standpoint, the reshuffle exposed deeper issues. Fitch Ratings noted these political moves could pressure spending and weaken governance relative to other ASEAN countries. On X, economist Trinh Nguyen warned that replacing the finance minister raises real questions about affording ambitious programs like the free lunches, which cost 1.5% of GDP, without blowing up the deficit. Domestically, think tanks like CELIOS have questioned whether the growth data is even real given declining confidence, while international observers like Carnegie Endowment are tying protests to elite collusion, suggesting that politics as usual is over. Heavy stuff. Before we get into the policy decisions, let's look at the August inflation data that set the stage. Indonesia maintained exceptional price stability. Headline inflation decelerated to 2.31% year-on-year in August, down from 2.37% in July, comfortably within BI's 1.5 to 3.5% target. Monthly, we actually saw deflation of 0.08%, notably deeper than the 0.03% deflation in August 2024. But the more revealing story is core inflation. It slowed to 2.17% annually, and critically, rose just 0.06% month-on-month, way below the 0.2% we saw in August 2024. This persistently low core inflation is basically screaming. Domestic demand is weak, despite what the GDP numbers suggest. Food prices were all over the place. Annual food inflation accelerated to 4.47%, driven by red onion prices surging to 54,331 rupiah per kilogram, well above government targets because of supply issues during Breeb's planting season. But monthly food deflation hit 0.61% as harvest seasons improved supply for chili and garlic. The government responded by adjusting rice pricing on August 22nd, after pest attacks pushed farmer-level prices to 6,862 rupiah per kilogram. The takeaway: price stability isn't the problem. Weak demand is. Though critiques are highlighting risks here. Social media users warn that programs like free lunches could inflate prices by 6.8%, adding health burdens from potential contamination. Over 5,626 cases reported. Economists argue that while interventions help short-term, they risk entrenching inflation without supply-side reforms. Government-aligned views obviously see this stability as enabling more stimulus without overheating. Predictable. Against this backdrop of stable inflation but post-reshuffle chaos, BI made its most controversial call of the year. September 17th, despite market analysts literally recommending a pause given the rupiah volatility, BI cut rates 25 basis points to 4.75%. Fifth cut in 2025, bringing total easing to 150 basis points. Let me be clear about why this was controversial. Market analysts had explicitly recommended holding at 5%. They argued that after two consecutive cuts in July and August, a pause was necessary to actually see if the transmission was working and to monitor the acute currency volatility. It was prudent, conservative, evidence-based. BI chose differently. The central bank justified it pointing to inflation within target, adequate foreign exchange reserves at $150.7 billion and needing to support growth toward that 5.2% target. But the timing raised serious questions. First, about central bank independence. Is monetary policy being subordinated to fiscal needs? Second, about blurring fiscal monetary boundaries, particularly around burden-sharing arrangements. Third, about whether transmission is even working. Interbank rates only fell 10 basis points initially, suggesting liquidity tightness rather than robust policy transmission. Headlines on September 19th said the Jakarta Composite Index hit a new all-time high after this surprise rate cut. So markets initially welcomed the accommodation. But the deeper question remains, is Indonesia's problem really insufficient monetary accommodation or weak structural demand that lower rates alone can't fix? BI rate now stands at 4.75%, down from 6% at the start of 2025. Whether this aggressive easing proves effective or just stores up financial stability risks, we'll see. Critiques abound. Reuters highlighted how the surprise cut put the rupiah in crosshairs, with a 3% slip in 2025 making it Asia's worst performer. Economist Trin Nguyen questioned BI's shift from rupiah stability to growth, warning it erodes trust amid fiscal questions. On the flip side, BNP Paribas views it positively, noting robust consumer spending justifies easing. In my analysis, this pivot aligns with Prabowo's pro-growth push but raises independence concerns, as central banking noted. It's a gamble. If BI's rate cut was controversial, the government's fiscal move was arguably even more so. September 12th, just 4 days after the reshuffle that already spooked markets, the government placed 200 trillion rupiah of state funds into state-owned banks, the Himbara banks. Substantial allocation. Mandiri, BRI, and BNI each got 55 trillion, BTN got 25 trillion, Bank Syariah Indonesia got 10 trillion. Stated objective: boost bank liquidity, support government priority programs, but the execution faces fundamental problems. Here's the core issue. Indonesia's banking sector already had ample lending capacity. Loan-to-deposit ratio stood at 86.54%. Banks weren't constrained by lack of funds. The real constraint is weak credit demand from businesses facing global uncertainty and investment barriers. This creates immediate moral hazard concerns. Will banks actually channel these funds into productive lending to the real economy? Or will they just park it in high-yielding, low-risk instruments like government securities or buy instruments? Financial arbitrage instead of real economy impact. Finance Minister Purbia Yudhai Saidwa tried to address this by explicitly prohibiting banks from using funds to purchase SBN or SRBI. Parliament mandated oversight through Komisi Xi DPRRI to ensure funds reach productive sectors and green financing, not just consumer loans. But credit quality concerns are real. NPLs already rose to 2.28% in July from 2.08% at end 2024. Aggressive lending in a weak demand environment risks making that worse. The 200 trillion rupiah question is this: will this massive injection overcome weak structural demand and flow into productive investment, or will it create asset bubbles, moral hazard, and financial instability? We're basically running a large-scale experiment on whether supply-side liquidity can generate demand-side momentum. Critiques from the diplomat warn of relief today, risks tomorrow, particularly with funds going to village cooperatives risking inefficiency. The Jakarta Post's Perbayanomics piece questions the whole philosophy, suggesting it could entrench rent-seeking. On X, users like at Sutan Manggara argue the economy is being choked, with funds not returning to people. Optimistically, Finance Minister defends it against deficit concerns, seeing it as spurring spending. In my view, this injection is a gamble if misallocated. It could widen inequality and fuel corruption, exactly what grassroots sentiments fear. Amid all this policy chaos, one genuinely bright spot: Manufacturing's dramatic reversal. Indonesia manufacturing PMI for August surged to 51.5, up 2.3 points from July's 49.2, definitively ending 5 consecutive months of contraction. This wasn't marginal. It was a decisive break above the 50-point expansion threshold. What drove it? 3 factors stand out. First, new orders jumped 4 points to 52.3, indicating renewed demand domestically and internationally. Second, and maybe most significantly, new export orders increased 2.8 points to 51.2. This suggests international buyers are returning to Indonesian suppliers as companies actively diversify supply chains amid US-China tensions. Third, production expanded to 52.6 as firms responded to demand signals, and employment rose to 50.4 as companies recruited more workers. Industrial Confidence Index registered 53.55 in August, confirming improved business sentiment. Output growth of 3.2 to 4.89% year-on-year was led by automotive at 6% growth, electronics at 5%, food and beverage showing strength. Machinery and mechanical equipment exports surged an extraordinary 53.8% month-on-month in July, clear evidence of Indonesia emerging as an alternative hub in fragmenting global supply chains. However, and this is crucial, sustainability questions remain. Is this genuine demand recovery or partly front-loading ahead of potential tariffs? Are export orders building durable momentum or responding to temporary factors? Analysts like those from Reuters note August's trade surplus widened due to sliding imports, but export growth slowed to 5.78%, weakest in 4 months, suggesting the rebound might fade. Critiques highlight that while PMI improved, broader growth slowed to 5.05% in Q2 due to government spending cuts. World Bank sees upside from reforms, but warns of risks from global slowdowns. Coming months will reveal whether August's manufacturing rebound is a genuine turning point or temporary spike. But for September, it was one of the few unambiguously positive data points. Finally, beyond manufacturing, let's look at how other sectors performed. Services sector maintained robust expansion at 5.2% year-on-year. Tourism recovery continued with foreign arrivals up 10 to 12%, reaching 1.2 million in September. E-commerce showed impressive momentum, with GMV hitting $8.2 billion, 18% year-on-year growth. Digital services contributed 45% of new formal sector jobs, underscoring structural transformation underway. Though critiques note digital gaps hinder 40% of rural firms, limiting inclusivity. Agriculture rebounded strongly with 3.2% growth after El Niño impacts. Post-crisis recovery story, favorable harvests supported rice output surging 13.9%, but localized pest attacks disrupted production in key regions. Mining and energy showed mixed results. Nickel exports surged 12 to 18% on Chinese EV demand, but coal shipments declined 3 to 5.2% amid global oversupply. Renewable energy additions of 15 GW advanced the 23% mix target, with green bonds up 35% to $1.1 billion. International views praise this sustainability push, but domestic critics argue it's insufficient against climate risks. Overall, sectoral gains are encouraging, but as McKinsey emphasizes, productivity reforms are needed for high-income status by 2045, critiquing over-reliance on small firms. September 2025 was marked by critical diplomatic progress securing and diversifying Indonesia's market access. September 23, Indonesia and the EU signed the substantive agreement for AUCEPA after almost a decade of negotiations. This creates a new chapter in trade history, following Indonesia's WTO victory over EU palm oil discrimination in January 2025. Finally, 2 days later, September 25th, Indonesia and Canada signed ICACEPA, further strengthening Western market access. Additionally, September 17th, Indonesia and Uruguay commemorated 60 years of diplomatic relations, focusing on expanding market access and investment. These agreements diversify Indonesia away from overdependence on Asian markets, particularly China at 25% share, and provide hedge against rising protectionism. Strategically, they support manufacturing and downstreaming by securing demand channels. Optimists like those from Nikkei see this as positioning Indonesia in global supply chains, but pessimists warn of implementation challenges and tariff threats from Mexico on vehicles and steel. We'll see. Labor market showed mixed signals with low headline unemployment, but persistent quality concerns. Headline metrics: official unemployment at 4.76% in March 2025, lowest since 1997, with alternative August estimates at 5.3%. Total employed reached 140 to 145.77 million, up 2.52% year-on-year. Employment composition: formal sector grew 2.1%, with services at 45% of new jobs and manufacturing at 25%. Informal sector expanded 1.2% but faces wage stagnation. Despite these figures, challenges include manufacturing job losses of 300,000 since 2023, indicating productivity gains displacing workers, underemployment requiring side jobs, youth unemployment at 12% in some regions due to skills mismatches. Wage dynamics: average growth at 4.2% outpaced productivity at 2.7%, but real wages are modest at 1.5% after inflation. Government's response includes comprehensive stimulus package, with cash for work programs creating over 600,000 temporary positions from September through December, and 6-month internship program for university graduates launching in October. But temporary programs don't address structural skills mismatches. Labor market quality improvements require deeper reforms in education, vocational training, worker reskilling initiatives. Critiques from LinkedIn analysts like Maria Monica Wiharja question if the 200T injection will create quality jobs or just short-term relief. On X, users express pessimism, citing stagnant growth and companies exiting, with policies deliberately keeping people uneducated. Optimistically, Apindo sees potential for 3.5 million jobs from the package. We'll see who's right. Beyond the controversial 200 trillion rupiah bank injection, the government unveiled comprehensive stimulus worth 16.23 to 150 trillion rupiah. Direct support measures included 10 kilograms rice distribution to 18.3 million households in Q4, providing immediate relief to vulnerable populations. Cash for Work program creates 609,465 targeted temporary positions from September through December. Tourism support through personal income tax removal for workers extended through 2026. Business support was substantial. MSME tax relief maintains 0.5% income tax rate through 2029 instead of scheduled increase to 1%, meaningful support for small businesses. Housing program targets 3 million units annually with 130 trillion rupiah in construction loans, government covering 5% of annual interest costs. Green investment incentives include 15-year corporate income tax exemptions for green ammonia projects above $500 million, aligning stimulus with sustainability objectives. Parliament approved 2026 state budget on September 23, confirming expansionary fiscal stance with 69 trillion rupiah allocated specifically to national health insurance premium financing. This addresses structural challenge of 56.9 million non-active participants unable to access services as of January 2025. Package represents determined effort to support growth across multiple dimensions: household consumption, business investment, employment, strategic sectors. Whether these measures can overcome weak structural demand remains the fundamental question. Economists say it's not enough without broader reforms, with Jakartaglobe noting post-reshuffle needs more than stimulus. Critiques warn of inflation and corruption risks, while optimists see it spurring 8% GDP growth. Time will tell. Economic performance across Indonesia's diverse regions showed persistent development gaps. Java, contributing 56% of national GDP, grew 4.6 to 5.1%, with infrastructure development like Jakarta's MRT expansion driving momentum. More than half the nation's output from this single island, concentration remains striking. Sumatra recorded 4.2 to 4.4% growth, facing headwinds from palm oil price pressures. North Sumatra was bright spot at 5.1% growth, driven by nickel processing facilities boosting electricity demand by 5% year-on-year. Kalimantan faced challenges with coal shipments declining 4% year-on-year amid softer Chinese demand and global oversupply. Nusantara Capital Project received 20 trillion rupiah in infrastructure allocation, representing government's long-term commitment to regional rebalancing. Eastern regions showed varied performance from 3.2 to 5.3% growth. Battery supply chain projects in Sulawesi offered economic opportunities, while infrastructure gaps remained binding constraint. Trans-Papua Toll project gradually improving connectivity, but eastern provinces still lag significantly behind Java in infrastructure, services, economic opportunity. These regional disparities matter not just for equity concerns, but for Indonesia's overall growth potential. Unlocking economic potential of regions outside Java could provide significant additional growth momentum. However, critiques note implementation gaps in Sumatra, 12% uptake, require parliamentary audits for transparency. On X, users highlight how reshuffles could consolidate fiscal tools but risk credibility loss. Indonesia's sustainability agenda gained meaningful momentum during September. Renewable energy capacity additions of 15 gigawatts in Q3 supported progress toward 23% renewable mix target by 2025. Solar rooftop installations grew 27% following feed-in tariff adjustments, improving project economics. PLN's solar tender of 500 megawatt peak capacity in East Nusa Tenggara represented largest tender outside Java, demonstrating commitment to distributed renewable development beyond the main island. Green finance showed strong growth with bond issuances reaching $1.1 billion, up 35% year-on-year. ESG issuances totaled 50 trillion rupiah. Voluntary carbon market rules finalized with credit registry launch scheduled for December 2025, creating infrastructure for market-based emissions reduction. Nusantara Capital Project conserved 20,000 hectares of forest, integrating environmental objectives into new capital's development model. Housing policy incorporated disaster resilience standards, addressing climate adaptation alongside development goals. These sustainability initiatives align Indonesia's development trajectory with global climate commitments, while creating new economic opportunities in renewable energy, green finance, sustainable technologies. Yet ADB's outlook reflects cautious optimism amid PRC slowdowns, critiquing prolonged domestic drags. Always something. Looking ahead, several significant risks and challenges cloud the outlook. External risks remain substantial. US-China trade tensions could disrupt Indonesia's nickel-to-EV battery supply chain, heavily dependent on Chinese investment and technology. Mexico's announced tariff threats pose clear risks for Indonesian vehicle, footwear, steel, electronics exports, sectors where Indonesia lacks FTA protection. Global commodity price volatility for coal and palm oil remains constant threat. Domestically, weak structural demand persists despite aggressive stimulus. Credit growth remains subdued at 8.4 to 12% year-on-year despite ample bank liquidity. Policy coordination uncertainty following cabinet reshuffle continues, affecting investor confidence. Manufacturing sustainability questions loom. Is August's rebound genuine or driven by temporary front-loading effects? Financial risks are building. NPLs deteriorated to 2.28% and rising, suggesting credit quality issues. Moral hazard from massive state bank liquidity injection could create problems if banks make poor lending decisions. Asset bubble risks emerge when massive liquidity meets weak real economic demand. Cabinet reshuffle's full implications for fiscal monetary coordination remain uncertain. Markets will scrutinize every signal about policy alignment and new finance ministers' approach to balancing growth ambitions with fiscal sustainability. International banker highlights protests underscoring deep-seated problems like inequality. On X, pessimists like at Isla Barawi decry fiscal crises and uncomfortable politics, normalizing abnormalities. Domestically, users warn of sluggish economy and hard-to-get foreign debt due to rating downgrades. Not great. Moving toward year-end and into 2026, several critical questions will determine Indonesia's trajectory. Near-term inflation outlook remains stable. September inflation forecast between 2.4 and 2.53% year-on-year, with October expected to see continued moderation supported by seasonal food price corrections and falling transportation costs. BI maintains confidence inflation will remain within 2.5% plus or minus 1% target range throughout 2025. But price stability isn't the binding constraint, demand weakness is. Government targets 5.2% growth, and Q2 momentum of 5.12% was encouraging. But sustainability depends on domestic demand recovery, not just temporary factors. Projections vary. Reuters sees 4.8%, while government eyes above 5.5%. Policy effectiveness questions are paramount. Can 150 basis points of rate cuts stimulate real demand when the constraint isn't cost of credit but willingness to borrow and spend? Will 200 trillion rupiah in bank liquidity reach productive sectors or inflate asset prices? Can fiscal monetary coordination be restored without compromising central bank credibility? Leading indicators present mixed picture. Manufacturing PMI's sustainability depends on whether export order strength continues and domestic orders recover. Consumer confidence fell to 117.2, suggesting household caution persists. Credit growth response to stimulus measures will be telling. Capital flow stability following September volatility will indicate whether investor confidence has been restored or whether political uncertainty continues casting shadow over Indonesia's investment climate. Optimists on X see new FM as market-savvy, potentially bullish for pro-market policies. Pessimists warn of stagnant 5% growth and deliberate undereducation fueling unrest. Drama continues. Concluding our analysis of September 2025, 3 key takeaways emerge. First, Indonesia demonstrated resilient fundamentals. 5.12% GDP growth in Q2 represents genuine economic strength, not statistical manipulation. Manufacturing's PMI recovery to 51.5 signals potential turning point. Indonesia's positioning in diversifying global supply chains, evidenced by that 53.8% surge in machinery exports, creates real opportunities. Second, we witnessed aggressive policy gamble. Combination of 150 basis points in rate cuts plus 200 trillion rupiah in liquidity injection represents determined bet that stimulus can overcome structural demand weakness. This is essentially economic experiment. Can supply-side policy tools generate demand-side momentum? Success is uncertain. Transmission remains muted so far. Critiques question if it's enough without reforms. Third, Indonesia secured strategic optionality. EU and Canada CEPAs provide crucial diversification beyond Asia, reducing 25% China overdependence and hedging against rising global protectionism. These agreements position Indonesia to benefit from developed market demand as global economy fragments along geopolitical lines. This brings us to what I consider the central challenge facing Indonesian policymakers. Can policy interventions overcome weak structural demand? Evidence of demand weakness is clear. Core inflation persistently low at 2.17%, credit growth subdued despite ample liquidity, consumer confidence declining to 117.2, potential front-loading effects masking true demand strength. Here's the fundamental insight. Indonesia's constraint isn't monetary policy space. BI has cut aggressively and could cut further if needed. The constraint is insufficient underlying demand from businesses and households facing global uncertainty, investment barriers, structural challenges. This means while monetary and fiscal stimulus may provide temporary support, durable growth acceleration requires addressing structural issues. Investment barrier reduction through continued regulatory reform and deregulation. Labor market quality improvements through education reform and vocational training. Productivity enhancements through technology adoption and infrastructure investment. The 200 trillion rupiah liquidity injection and 150 basis points of rate cuts are large numbers. But if they're pushing against weak structural demand rather than removing binding financial constraints, their effectiveness will be limited. As the diplomat critiques, channeling to cooperatives risks inefficiency and corruption. On X, sentiments echo, private sector not growing well, swarmed by rent attached to government. Optimists counter that reshuffles could boost fiscal consolidation and credibility. This doesn't mean stimulus is wrong. It may prevent sharper slowdown and buy time for structural reforms. But policy expectations should be calibrated accordingly. Stimulus alone won't generate broad-based, sustainable recovery Indonesia seeks without parallel progress on structural reforms. September 2025 will be remembered as month of bold action meeting uncertain outcomes. The month crystallized Indonesia's economic paradox. Strong growth numbers coexisting with fragile confidence, aggressive interventions meeting market skepticism, diplomatic success achieved amid domestic political uncertainty. BI's controversial rate cut, government's massive liquidity injection, cabinet reshuffle's market impact, manufacturing's dramatic rebound, landmark trade agreements. These events collectively define critical inflection point. Coming months will reveal several key outcomes. Will manufacturing's August rebound prove sustainable or fade as front-loading effects dissipate? Will 200 trillion rupiah injection channel into productive lending or create asset bubbles and moral hazard? Can fiscal monetary coordination be restored without compromising central bank independence? And most fundamentally, can bold policies translate into sustained, broad-based recovery? Indonesia's economic story remains unwritten. Fundamentals are solid, healthy external accounts, manageable inflation, decent growth, strategic positioning in global supply chains. But challenges are real, weak structural demand, political uncertainty, external risks, questions about policy effectiveness. September 2025 presented both opportunities and risks. How policymakers, businesses, investors respond to this critical moment will shape Indonesia's economic trajectory, not just for remainder of 2025, but potentially for years to come. Bold actions taken in September represent bet on Indonesia's economic potential. Whether that bet pays off depends on execution, coordination, external developments, and most importantly, whether stimulus can catalyze structural demand recovery that remains elusive. Diverse views underscore this. Domestically, voices decry misallocation and rent hunting. Internationally, analysts praise resilience but urge governance fixes. On X, pessimism abounds with calls for realism amid crises, while optimists see momentum in investments like Agrina's Pangan's $479 million commitment. Thanks for staying with me through this deep dive into monthly Indonesia economy focus. We'll be watching closely how these September developments unfold in the months ahead. Join me next month for continued analysis as Indonesia's economic narrative continues to evolve. Honestly, can't wait to see how this all plays out.